We did, but you logged in.
Yesterday?
Yeah. Yesterday I went through the slides for Learning Unit 2, remember?
But then I logged in, said, yeah, this is what it said.
But isn't you Brandon?
No, I'm excellent.
Oh.
This is what it said.
That's what I said. Yeah, no, we did have class yesterday. There was Brandon there, and then I've forgotten the other lady that was also there.
Really?
Yeah.
What link?
But we just covered the slides, and I saw that in your more resources. You didn't have my slides, but I thought I had uploaded them. But I uploaded them this morning. So they're now there. But we just covered Unit 2, just the slides. So just the theory to it all. Just the theory to it. Yeah?
So which link do you use? The one you...
Yeah, so show me where are you talking about the switch off?
The activities.
Yeah, the activities.
Check my phone.
I think it's this window that's causing it.
I can see it. There's an empty sentence in the...
So revision exercise. Let me come see. Where do you think it's?
Yeah, I think this is it. You sent us an email saying we're supposed to. I think it's the email too. Yeah.
So this isn't me. I think there's another administrator who's sending out these things. Because I don't know. I'm seeing this for the first time, and I never would have sent the case study stuff. So I think there's other administrators who are sending it and then notifying you that it's available for you guys. So yeah, by all means you can do it, but I haven't set them up. I haven't done it myself. It won't count for any ice marks and stuff. I have on my side. Let me show you now. Okay, at least you can see the board, so that's cool. So I have, this is 1, 2, 3, 4, 5, 6 ice tasks that I'm going to give you guys from my side. And that's, yeah, we'll obviously just pick, is it the best 4 or the best 2? And then obviously just attendance and stuff. Okay, that's it. My side. So you can obviously do that. I mean, the more stuff you guys do, the better. It will obviously prepare you for your test and exam. So there's no problems there. But yeah, from my side, the only ice task that you'll get from me will be in that ice activities folder. Yeah, and but I will send out an announcement or an announcement and email when I've now released that to you guys. Yeah. So where I want us to start is I actually want us to cover learning unit 1 and unit 2, but now from an exercise standpoint. But now obviously we don't have time to even, like you saw last year when we were together in 2A. When we do an exercise, literally we could do one exercise, both sessions, just cover one. So even here we don't have time to actually go through exercise. So what I'm going to do with you guys is, like I was telling the guys yesterday, is go through content. So I told them the next time I see them, they should have gone through Unit 3. And then if they have questions, then I can say, okay, no, this is what they're doing there, this is what they're doing there. That's the only way we can do this. And then obviously my slides I've already made available to you. I don't know, I was so surprised because I thought when I put in the ICE activities that I had also shared my slides so that you guys have them already. So that there's nothing standing in your way, like if you want to go ahead. So I did it this morning. So literally from Unit 1 all the way until Unit 8, it's there under lecture slides, okay? So I also want to just show you this before I get into, you got past paper revision there. There you got all your past papers up until 2018. Okay, so you could probably get the rest of them on your library, but at least those are there. Yeah, and then you have one suggested answers paper there as well, just to give you guys some experience in terms of how they ask things. And here, Guru content, I only got learning unit 1 and 2. There wasn't any more Guru content that was developed. So I've also shared that with you guys as well. But what I really want you guys to see, where did I?
So we're from just one. It's not the weight.
Sorry, say it again.
The test for balance.
Yeah, you guys, I'm not so sure if they're going to give you a test. Let me see here, because I did write down on my timetable. Let's see. I don't think you'll have a test 1. Yeah, it's on weight because of yeah, the way the semester is all set up. But you will have a test 2 in October. So I'm guessing they'll use the ice marks for that. Is that what they've done in the past? Okay. All right. No, it's fine. No, it's fine. Okay. Yeah. So 21 October, you write your test 2. Then when is your exam? Your exam is on 23 November. So I don't know if you want to write that down somewhere or. Okay. All right. No, then that's fine. Cool. So I'm now just trying to see where I uploaded the formula sheet to that I'm talking about now. I thought I had. Okay, so let me just quickly upload this. I hope I didn't upload it to the wrong group. Okay, and it's a Word document. The reason why it's a Word document is because I want you guys to continue to create the formula sheet. So now for learning units 4, 5, 6, 7, 8, I want you guys to continue. I want you guys to continue to obviously to continue to develop that as you study those learning units. Okay, now that's there at the end of that. So if you go to more resources, you'll find that formula sheet. Okay, so that's where we're going to start for today. Yeah. All right. Yeah. So this is literally the first time you're doing this module. Right? They just have it on phase out because your program is changing. Ooh, I see. Okay. Right. So, like I said, here's your formula sheet. Now this is the for learning unit 1. All right. Now this is your typical cash budget structure. All right. and here they're using for the period January until March, okay? So obviously you will have an opening balance in January. But now where do you get that opening balance? That opening balance for January will be the closing balance for December, okay? Then when it comes to estimating receipts, in other words, estimating the money that's coming in, okay? This you don't need to write down because this is the document that has more resources. So you can even, yeah, perfect, you see. Then estimated receipts, so you got total of the below line items. So when it comes to money coming in, we have two types of money that will be coming in. It's either cash sales, all right, or any cash revenue, okay? And then we have credit sales, okay? So cash sales is simple because we know, okay, for January, this is the cash sales that we received because we know that's the money we received, went through the till. So that's how we're confident about how much we have actually received, okay? Welcome, welcome. Then when it comes to where things get a bit challenging, is when we now have to figure out how much credit sales are we actually going to receive in the month of January. Okay. So I'm guessing you're Brandon. Yes. Okay, so we haven't really gotten started. We just got started actually. And I've uploaded this document onto more resources. It's the formula sheet. Okay. And it's for learning units 1 to 3. And obviously, I was telling him earlier, that we don't even have enough time for me to properly go through exercises with you because, and he'll confirm this, when we're doing 2A for finance, one exercise can take 2 sessions. So it's literally a thing of just giving you the steps and guidance to, okay, this is how you deal with the problem. These are the type of questions they'll ask, etc., etc. So I wanted to just start with the formula sheet because when it comes to finance, you need a formula sheet. So you know that, okay, it's like maths in a sense. You need the formulas for that unit, you got those formulas, and then you obviously just do exercises, and before you know it, the formulas are now in your head. And then you're good to go. So in unit 1, we know we're covering budgets. So here we're looking at the budget structure. And then obviously we have opening balances, the closing balance for last month. Then when it comes to your receipts, estimating your cash or the money you're going to receive in that month, we know that it's split between 2 things. You have the cash sales, all right, or any cash that is being received in the business. Then you have your credit sales. Okay. When we say credit sales, we're talking about people who have bought from us previously on credit, and then now they're only paying now. Okay. So we have to then, in order to estimate what our credit sales will be, because cash sales is easy. Whatever is in the till in that month, those are our cash sales. But now with credit sales, that's where it gets tricky. We have to build a schedule, all right? Age analysis for our debtors, okay? So he bought goods from us in October, okay? And we know that he's going to pay X amount in November, X amount in December, and then X amount in January, which is the month that we're in, okay? So on that schedule, we will know how much our debtors are paying us in, or for January, okay? And then that's how much we'll put in the budget. And then loan repayments, we also know how much we will be paying out, okay? And investment income, we'll know how much we should be receiving, okay? There are various other line items, but the real work here is getting your debtors and creditors analysis or schedules, all right? If you can do that, this is easy, okay? Then, here now we're talking about, where is the credit? Okay, so that's your total cash available in terms of cash coming in. Now the next thing is we're estimating the cash outflows. And it's the same principle. What are the things we know we're going to pay for in cash? Okay, that's your cash purchases. Then there's other payments to creditors, people we now owe. And in order to do that, we also need to do a creditor's age analysis, or you could call it a creditor's schedule. I see in your textbooks they like to call it a creditor's schedule. Okay. In industry and when we were in school, they would call it a creditor's age analysis or a debtor's age analysis. Okay, but it's the same thing. Then you've got salaries and you've got other expenses, and they could throw other expenses into your budget, like you're going to pay for a computer in the month of March, things like that. So you just need to, they could be once-off, some of them could be reoccurring. Like we said, we also want you to account for depreciation, so then you need to make those type of things, okay? Include those type of things, I mean to say, sorry, in your schedule. I see here staff bonus, company tax, okay? Those are the type of things that we are talking about, okay? They'll give you the tax rate and things like that, okay? So the budget is not hard because typically they'll give you the structure of what they're looking for, or they'll tell you, and then you obviously just need to plug it in. But this is where the work now begins. It's now creating the schedule of budgeted receipts, okay? In other words, a debtor schedule, right? And now here is where now you need to be structured and know how you're actually planning to go about this. Okay. Did I include steps as to how to build that? Okay, no, I didn't. Okay. But the first thing that you want to do when building your schedule, and the way you build your schedule for receipts and the way you build your schedule for payments is exactly the same. First thing you want to do is say, okay, this schedule, for which months am I doing it? Okay, we're doing it for December all the way until April. Okay, and the budgeted receipts were focused on January, February, and March. Okay, then you say to yourself, okay, fine. They're going to then give you what were the credit sales, all right, for the month of October, for the previous months. They'll tell you how many months. Then they'll give you the credit sales during the month. Sometimes they'll give you the credit sales, the actual credit sales for the previous months, because October, November, and December happened, right? So we know the actual credit sales. But when it comes to, let's say, because we're doing the budget for January, February, and March, you won't know the actual credit sales. Does that make sense? So they'll tell you, we budget that we're going to have these amounts, and then you just work off of those. Okay. Remember, it's a budget, it's a forecast, it's a prediction, but it's not to say that's exactly how much money we're going to have or how much money we're going to receive. Just allows you to have a ballpark figure. All right. So once you now have that, once you now have the budgeted, what is this? Credit sales, then you ask yourself, okay, fine. They will then give you a breakdown to say our debtors pay us 50% in the first month, okay, following when they took the money out, 20% in the following month, and then they can say the remaining 30% in that final month, okay? That's where things, I think, get tricky for a lot of students, okay? So that's where you need to practice to say, okay, what does that then mean? Okay, so yeah, I don't know what percentages we used, but I see I used some letters there. So I hope, did we do the calculations in there? Doesn't look like.
What is the parts
It's calculating those percentages because people get confused with the wording in the sense that when you say, for instance, 50% in the next month following when I bought the goods. Some people think in that very same month. So for instance, I bought the goods in December. So if I say in the month following, that means I'm paying in January that 50%. Does it make sense? Now some people will put that 50% in December. And sometimes in the question they'll say within 30 days. Again, they're talking about the following month. You see, so that's the thing. Like you have to, yeah, because I mean I would have gotten it, let's say 15 December. So can you see how that payment now comes in January? You see, sometimes they'll say within 60 days. So then you're like, okay, not December, not January, but February, and that's where they get caught up. But it's a thing of
I can tell you this now. The good thing about finance is they'll never ask you a question that they haven't asked in the textbook. I'm sure you saw that in 2A. There's even one that you're like, oh, flip, I didn't prepare for this question. You're like, but I did see them ask a similar question in the textbook. That's the good part about it, about finance. So it really is a thing of you guys just need to really practice to get used to that wording, because that's where people mess up when it comes to the schedules. But otherwise, this thing, it's tedious in that it can be long, but the good part is in your test or exam, they won't make it long because obviously you need time to do other questions. But once you get this right, you're home and dry. Because now you know, okay, from November and from October and November, this is the money that we can expect, or let me, from here, from October, November, and December, this is the money that we can expect coming in from our debtors for January. Can you see that? So then we simply say, okay, cool. We add all these amounts up, and we know, okay, this is the total amount we're receiving from our debtors. Then we go and plug that in the overall budget. Does that make sense? So once you have done this, then you're home and dry. Okay. The others is that's small, it's simple mathematics. It won't give you headaches. So, like I said, the budgeted payments or the schedule of budgeted payments is the same. All right. The only thing you're dealing with here is now you're saying we are paying someone as opposed to us receiving the money. Okay. So that's your learning unit 1 in terms of the cash budget, right? Then we also have a sales budget. We also have a sales budget, and your sales budget is literally how many units do we plan to sell? And what price are we selling each unit? Okay. Then you times the 2, and then you have your total sales. So can you see how I'm trying to make your life easy in that now you have the actual structure for the sales budget, okay? Then you move on. Now we have the production budget also as well. This is your structure, okay? I think that's my, that's fine. Then we have the production budget, right? Now here literally, we're looking at how many units do we plan to produce, all right? We know how many units we want to sell, okay? Remember, these are budgets, so we're saying this is what we want to achieve. We know how many units we want to sell. We know the price at which we want to sell them. So already you can see now, okay, we can see how much we plan to make for the different months in terms of sales. Now, the next step in the production budget is we're now saying, okay, in order to achieve that, we obviously need to produce the units so that we can sell them. Does that make sense? So that's what we're looking at here. We're saying, okay, cool. We budgeted sales in units to be this 3,700 and, let me zoom in. This 3,720. Cool. Okay. Then what we require in the following month, okay, in December, all right, we require that our closing inventory, in other words, the amount of stock that we must remain with at the end of the month must be equal to the amount of stock that's needed to sell in the next month. Usually they'll include that in the question. So here obviously it's just a formula sheet, so I haven't included that information somewhere. Okay. So we then know that, okay, that means that the required closing inventory of finished units is then what we plan to sell in the next month. So this is a copy and paste because it would have given you this information. Then you say, okay, then what are the total units needed? This is how much I want to sell in November. This is how much I need to have at the end of November. Okay? So then the total number of units needed is this 8,680. Cool. Then we say to ourselves, how much opening inventory? So in other words, at the beginning of November, how much inventory did we already have? Because since we already had it, that means we don't need to produce all of this 8,680 units. If we didn't have anything, then we would have needed to produce all of it. Does that make sense? Exactly. And then you know, okay, this is the production that we need to do for the month of November. Is it making sense? Okay. So then once you've done that, you say, okay, cool. Right. We know this amount is already given to us in the question. Okay. Then we're asking ourselves, okay, this time, how much required closing inventory do I need for the month of December this time? Again, we're looking at the month of January to say how much do we want to sell in January. And then, so this number is what we copy and paste in here. Does that make any sense? Then we say, okay, total required. So we add these two together and we get there. And I'm sure now you're getting the flow of things, okay? And here, obviously, this is what we opened with, because remember, this was our closing from the previous month, all right? So this was what the opening for this month. So these are the small things they don't communicate to you, that if you don't understand what you're doing, you obviously won't be able to say, okay, no, this information is obviously, or this number is obviously the same as the closing for the previous month, okay? Then obviously you get this number when you subtract it, and then you continue to do the same thing. Now, can you see here? I've put in the bullet point. 4,960 units in February. That's how much they want to sell in February. Here they made us do a budget from November to January. Okay. So then the reason why they told us that is so that we can have something under the required closing inventory over there. Okay. Then when it comes to the total budgeted units for the quarter, because this is a budget for the quarter, production budget for the quarter, we're obviously just adding all three of these to get that. But now, when we come to the total required or the required closing inventory for the quarter, we don't just add everything here. We take the amount that is required at the end of the quarter. And that's why I put this in red. Does it make sense?
That'll be February, right?
That'll be February, yes.
The closing quarter.
So I say that again?
So like I'm saying the quarter total,
yes.
That 496, that'll also be fair because that's when
yes.
You're going to need for the next quarter.
For the next quarter, 100%. So I'm trying to, I feel we're getting each other, but I just want to explain it in another way just to make sure that it sinks. Remember, we're doing the budget for the quarter, right? And we're saying at the end of the quarter, what is going to be the required inventory for the next month? Does that make sense? The closing inventory for that is required. And we're saying, okay, at the end of the quarter, we know that February, we require 4,900. So that's why we're just plugging it in as that. We're not going to require this 4,960 plus 6,200 plus another 4. Does it make sense? So this is one of those ones where it's like, if you haven't practiced, if I haven't explained this, you'll be like, it doesn't make sense. How come we're adding everywhere else, but here we don't? Okay. But I'm sure now it's sunk. Cool. Then we say, okay, what is the total units needed for the quarter? All right. Again, over here, what we're doing is we're then saying, okay, the total budgeted units, okay, for the quarter, budgeted sales units for the quarter, plus the required at the end, will then give us this 19,000. If you can even just look, you can see 11,000 plus 11,000 does not equal 19, right? So you have to add these two here to get to this 19, okay? Right. Then, again, what is then the opening inventory? Remember here, when we're looking at this column, we're saying quarter. And the opening inventory was what we had at the beginning of November. Does that make sense? And that's why I put that in blue. Maybe I should also put this in blue for you guys. Okay. And then finally, obviously, then what was the total amount of production in terms of units that we needed to do for the whole quarter? And there we're saying the 19,840 minus the 2,480, and that's how we're arriving at that. Is it making sense now? So it just gets a bit tricky when you're doing the quarter totals, and also when you're looking at the required and looking at the opening.
So I don't understand why we're supposed to use the 2.4.
Yes.
480 on the quarter total.
On the quarter total.
November one, yeah.
So remember, we're saying a quarter is 3 months. Eh? So we're saying, and here we're obviously looking at quarter totals. So we're saying for this quarter, how much inventory did we start with? Can you see? And we know that this quarter starts in November. So whatever we started with in November is what we started with. Is it making sense now? Yeah. Okay. Right. So we're happy with production budget now. Okay. So I think for me, in my mind, you need to know the structures of these. That's what you now need to master. And then now that you understand them, since you now have the structure, it'll be plug and play. Simple stuff for you guys. So the next one that you have is now your raw materials budget. Okay. Now this one is a lot like the production budget. The only difference is now we actually want to know how much materials we need. Okay. So you have to have done the production budget first to know how many units do I need in this quarter, all right, for the respective months. Then all you're doing is literally saying, okay, if I need 2 kgs per unit, then you're just saying 2 kgs times the number of units, then I get my total in terms of materials. That's what we're doing. So here you can see budget production in units, 6,200 is the same one we had there. Then we're saying need 2 kgs per unit, okay? So the 2 kgs times the 6,200, that's how we're getting to the 12, okay? Then we're saying materials required for production, okay? Required closing inventory, we know that the required closing was that 6.2, so we're timing it again by 2 kgs. Then, can you see, the format is exactly the same. The only difference is we're timing in the 2 kgs for all the places where we have units. So then total direct materials needed, we're adding that 12,400 plus the 12,400 to get the total needed. Then we're saying less the opening inventory of direct materials. Okay, we know that we had we had 2,400 and something as the opening inventory. Oh, so here's the tricky bit. This is the opening inventory, not of units, but the opening inventory of materials. Okay, so when I was thinking just now, I was thinking that the opening inventory for units completed should be the same as the opening inventory for materials, and it's not necessary, because remember, raw materials, this is just scattered stuff that we are yet to actually produce. And then when it comes to the production budget, we're talking about things that are actually produced, completed units. Okay? So this information here will be given to you to say you opened with 14,600 kgs of raw material. Does that make sense? So you plug that in there. Then you now know the total direct materials that you need to purchase for the month of November, because you've subtracted how much is needed from how much you already have via opening. And there you go. Then we have the purchase price per kg. You know how many kgs we need? We have the purchase price per kg, we times the 2, and that's how we get to our total direct material purchase for the month of November. Okay. And then we literally just do the same thing that we're doing with the production budget, but now we're obviously operating in the raw materials. Okay. Here you can see I put this in blue because again, this is the opening direct materials, right? Opening inventory for direct materials is the same as at the beginning of November. Here I put this in red because what are we saying? To get the total needed, we are saying this amount that we have, yes, this amount of 34,000, all right, that is required, less that which is, wait, give me a second now. Materials required, we're saying 2 times that 17, that's how we're getting that. right? Happiness there. Then this 9,920. This is the amount of required for the month of February. So we're happy with that. So we're then saying the total needed is this 44 because we're adding those two together. Fine with that. Then,
So the 44 comes from
these two being added. Then this 14 we know is coming from there. So then this 30 is coming from the difference between these two. Then obviously we're just timesing this by 1.5 to get to this.
the 80.
Yeah, to get to this 30 times the 1.5, because this is the total materials that we need to purchase, but then how much are we going to actually spend on that? Yeah. All right. Makes sense. Okay. Yes.
So for December, I'm confused.
Yeah.
So I see that has the 9,930. Isn't that like the units required for February?
That's also the units required for Jan. Because can you see how much they said here? Materials required.
Oh, okay.
Or should I say, let's do it like this. Let's do it like this. How much are we planning to sell in January? Can you see the 4,960?
Yes.
So that's how much we plan to sell. So we know that if that's what we plan to sell in January, by the end of December, we need to have those units. Does that make sense? Now we're just saying, okay, in terms of material, because these are units, we want to convert it into kgs of material. That's how we're getting this 9,900. So what we are beginning to see clearly is that January and February are requiring the same amount of materials because we're planning to sell the same amount of products. Yeah, that's why we have it in both. All right. Cool. So I think the raw materials one and the production one can be a bit tricky just because you need to be obviously awake when doing them. But I think once you practice one or two of them, you'll be fine. Okay. Then we have the direct labor. This one is even more simple in my mind because here, all that we need is the budgeted production in units. So remember now, when we're saying the budgeted production in units, we're saying we know that we had opening inventory, we know that we had a total required, okay, for the month, okay, and we subtracted the total required for the month from the opening to get how much we actually going to produce. So then we take that, how much are we actually producing in November, times the labor hours needed to produce one unit, okay? That's how we're getting the 18,600. Then we're saying, okay, cool. Now that we know how many labor hours are needed to produce how much we plan to produce in November, we're then saying, how much is that going to cost us? So times the hourly wage rate, so that we know how much we're spending on labor. Does that make sense? So this one is pretty straightforward. It's just about getting that budgeted production in units correct. Once you have that, I think you guys are good to go. Right.
I'm guessing they will give us like the hours needed and the hourly wage.
Yeah, they'll have to give you that. They'll have to give you that. The trickiest way that I think they can bring that to you is maybe they say it casually. Like they'll say, in the past, we've spent 3 hours on labor, on every unit. 3 hours, yes, of labor on every unit, all right, to produce every unit. Does that make sense? Then I'll tell you from previous years, we've spent 6 rand per hour on labor hours. Does that make sense? So they can say it casually like that. So you'll be thinking, but I don't know this information, I don't know this information, but it's there. As particularly if they do not say anything in relation to that later on, like say, this year, this is how much we anticipate to pay, etc., etc. So yeah, that is your learning unit 1. Well, actually, the budget side of learning unit 1. This is now your learning unit 2. I'm sorry, this is still part of learning unit 1, but we did this in 2A. And I see they're bringing it back. I don't know why, but it's just variance. Yeah, guys, know this stuff. And because I can tell you now, they like to ask this thing. They like to ask it. And so here, what I recommend that you do is to always go actual minus budgeted. Actual cost minus the, here they're saying, sometimes they say this is standard cost, it's the same as budgeted cost, okay? Then times the actual issued. So here, basically what we're doing is to say it's variance, right? We're talking about, okay, cool. We budgeted that it's going to cost us, or just give me a second here. And his mouse is going to throw it very dry very quickly. Okay. So we've budgeted, right? That we're going to spend 3 Rand on every material that we purchase. However, when we go there, we might realize that actually the actual cost that we spent was 3 Rand 25. So then, when we are now checking the variance, we will say actual was 3 Rand 25. Budgeted was 3 Rand. So the variance there per unit is obviously that 25 cents. Then times the number of units that were actually issued, in other words, that were actually bought. Let's just say we bought 10, okay? So then obviously then the variance in terms of cost would then be 2 Rand 50. Can you see? The reason why we do this is to say, obviously, when it comes to these variants, we're saying that during the course of the year, we might not actually have time. We might not know our actual cost. Let me say that. We might not know our actual cost. But we would like to allocate monies to costs that we anticipate that we're going to pay for. That's why we say, okay, no, according to the past, we've spent only 3 Rand on every unit. Okay? Then we realize actually we spent 3 Rand 25. Obviously, we're going to adjust our books accordingly to reflect the actual costs. But in the meantime, we have to put in something in our books. So that's what's happening over there.
So what's the assistant?
The budgeted cost. Sometimes they'll say the standard cost. Yeah. Sometimes they'll say the standard cost.
What's the difference between include issue and include purchase? Because it said include issue is issue was what? And then now purchase is not the same thing.
So the formulas are quite the same. I know there is supposed to be a difference. Material purchase price.
You have these formulas in the textbook.
Yeah, they are there in the textbook. They are there in the textbook. There are also exercises in the textbook of them, or with them. Yeah. So I'm just flipping. If in my book it's on pages 34. See, I'm thinking, you know what, ne? So the one that I was explaining is actually the one in terms of purchase. Then when we say issued, we're actually talking to actually being used. No, but I see used is this one, usage. In production. What is the story here? Because like you're saying, and I agree with you mathematically, this is going to be the same. Okay, so let's actually read. This variance occurs when there is a difference between the actual quantity issued at the actual cost and the actual quantity issued at standard price. It shows the difference between the actual cost and the standard cost of the material which has been issued to production. Okay, happiness there. That's the material issue price variance. Okay, so that's the first one. Then material purchase price variance. This variance occurs when the actual price and the standard price of material differ. Okay, it shows the difference between the actual cost and the standard cost of material which has been purchased. Okay, so I was correct in my correction. What I was describing was this in terms of purchase. Okay, so I was describing the second one. Now, issued, here they're talking to issued to production. Can you see at the end of that last sentence there, before the formula? Issued to production. So, when we say issued to production, we have the units already, but now we're actually providing them for production. Okay, but now I'm even getting confused now with this usage, material usage variance. Let's read that. Sorry guys, I have a throat infection, so I'll be allowed.
So how are we going to be given the figures, the issue or the purchase?
You'll be given the figures. You'll be given the figures, but obviously you won't be given the formulas. So you'll need to know these formulas. And this is why I put it like this, because I don't know, I think this is in your textbooks. I know I pulled this out of your textbooks. Yeah. If you look there on page 42, it's there. But now they just didn't put them all together. So let me just quickly read this material usage. The material usage variance is the result of a difference between the actual amount of material used and the standard quantity of material allowed. It shows how efficiently raw materials have been used. Okay, allowed and used. So basically, what we're saying, allowed and used. So how much was actually? So we can say we've given you 10,000 worth of units, okay, to use, but you only use 8,000. Does that make sense? That's how much you use, but you've been allowed 10,000. And if he uses, yeah, that's the last one, material used. Now, if he uses 8,000 instead of the 10,000, it shows how efficient he is, because he's managed to use less than what was allocated to him.
Or the issued is what was allowed, and then usage is what he used. That's the difference.
Yes. Yes. How much he used in relation to how much was budgeted for him to use.
Oh.
Does it make sense?
So that's how we measure the efficiency.
Yeah, that's how we measure the efficiency. So can you see, but even the formula here, can you see is different? Because we're saying how much was actually used, okay, per unit, minus how much was actually, how much was budgeted to be used per unit, right? Right, these are per unit, all right? Then here is times the number of units. Does that make sense? Am I confusing you?
What's the SQ for now?
SQ is the standard quantity.
Standard quantity used.
So this is the standard quantity allowed, and this one is the actual quantity used. Does that make sense? And then times the budgeted quantity that we planned.
SQ is basically the AQ issued.
Yeah. You could say it's the one that's issued. And then this is the what was used. And then we're timesing by how many we plan to actually. So it's one of those that, hey, we have to practice these in order to master them. You'll find that these are so close, you need to distinguish between what was issued and what was purchased. What are they really asking? Usually it's about what are they asking, what do they want you to find out? And so in the question, they will highlight to you, we're looking at the variance of how much we spent on this versus how much we planned to spend on it. Then you know, okay, I'm looking at purchased. When they start to tell you about material issue price, okay, then you know, okay, it's about how much we actually issued, allowed for production. Then with usage, now we're talking about, okay, versus how much we allowed him or permitted for him to use versus how much he actually used. Okay. So yeah, it's really, I think once you understand what they're asking, it'll be easier to actually navigate which formula to use. But yeah.
So which formulas do you use?
I recommend the alternative. Because I think it's more straightforward. Because here's the other thing. You also then need to speak to, is it a favorable or unfavorable? You see? And now here's why I always recommend you subtracting the actual from the budgeted. Let's say this number is 8, and this number over here on the SC is 10. Can you already see mathematically you're going to have a negative? Yeah. Okay? Right?
Okay, so
Actually, no.
So are we expected to motivate once we get the answer?
Sometimes they'll ask you to state whether it was favorable or unfavorable. So actually, my recommendation is that you start budgeted minus the actual. This is how your textbook does it. I actually recommend that you go budgeted minus the actual. I explain to you now. Why didn't I give you these formulas as I recommend them? Okay, here's the reason why. Let me explain why I say you must go with budgeted minus the actual. Because if you budgeted, like I was saying, that's 10, right? 10 minus 8. 8 was the actual, right? If we budgeted more than we actually spent, it's a favorable situation. You get what I mean? So 10 minus 8, you already have a positive 2. You see? So already, because you have a positive figure, you already know this is a favorable situation. If you have a, now let's say our budgeted was 8 and our actual was 10. Now we have a negative 2. Already you can see, this was an unfavorable situation. We budgeted less than what we actually spent. That's a problem, okay? So that's why I like it when we start with budgeted, because it's like, my students know, just based off calculating it correctly, they already know whether this was a favorable or unfavorable situation. So with this one, let's say actual was 8 and budgeted was 10. You come up with a negative 8. Yeah, it would come out as favorable, unfavorable.
No, but then the actual is 8.
And the budgeted
is 10.
Yes.
But in that order, it's going to look like negative 2.
There we go.
Confuse you because then it's still favorable, because when you see negative, you're going to think it's unfavorable.
100%. Can you see? I even got confused. Can you see?
That's why, yeah. That's
So which
Do you
formula
get the
do you use?
Huh?
Which formula do you use?
Go with budgeted first, minus the actual. Because then you know that your output, as long as it's positive, then you have a favorable situation. Does that make sense? Because this is according to cost. Okay? We're doing variance according to cost. If we're doing variance according to income or revenue generation.
What are we actually calculating here?
Yes, we're calculating the purchase price.
But now we're saying budgeted.
Let me start here. What we are calculating is the variance between what we actually spent and what we budgeted to spend. Does it make sense? Now we're together, right? So the variance, was the variance a positive variance or was it an unfavorable?
So I think we need to make a balance.
Yeah, I think definitely. My recommendation is that you switch those around.
Only for budget.
No, for all of them. For all of them. And you'll see even when we do things like the applied overhead,
So which one are we also changing here?
you will see that isn't the formula, the principles remain the same for all of them. I want to give you guys a break, but I see we're really in the thick of things. So you see we have labor variance as well. So can you see again it's actual, right? Versus the budgeted. Again, actual budgeted. So we continue on that same, it's now that we're just looking at labor variances now. And then if we go further down again, you see machine overhead variance, okay? So again, you're looking at actual minus your standard rated. But again, I recommend you spin those around to have budgeted, then minus your actual. Okay, are you guys good on that front now? So maybe just to quickly speak on this so that when we come back, we get into learning unit 2. So here, the direct labor rate. Okay, so we're saying, what was the rate that we anticipated that we would spend versus the actual rate that we are spending? Okay, what was the variance between those two? Okay, and then obviously times the actual time that was spent for labor. Okay, then here, what are we saying? Labor efficiency. Now we're saying, okay, here we're now looking at how efficient have we been with our labor. So can you see, this is basically the long root of it. We're saying, okay, the standard or the budgeted time, right? Yeah, this should have been ST. The budgeted time, let me just say budgeted time times the actual rate. And here should have been budgeted time times the budgeted rate, okay? Then we're saying, what is the difference between the two? Because basically we're saying, we anticipated that we would spend so much money on our labor hours. Did we actually spend less on our labor hours, but based on the budgeted time? Does that make sense? So that we can see, were we more efficient than we actually planned? Does that make sense? Or less efficient than we actually planned? That's what we're trying to see. Okay?
It's the same thing as the previous one we're doing. It's just different.
It's just that in the first one here, yes, exactly, as they were previously doing. Now we're just focusing on labor. Does it make sense? And in this first formula, at least these ones are clearly distinctly different. In this first formula, we're working with actual time, right? Because we want to know money-wise. Here now we're focused on efficiency. That's why we're using the based on what we budgeted in terms of the time, right? Did we spend less or did we spend more? Okay. And then this last one, total labor. Okay, that's now we're looking at the difference between the two. Your standard time times your standard rate, or budgeted time times your budgeted rate. Then the difference between your actual time and your actual rate. All right, that's the total variance now, or labor rate plus labor efficiency variance. Okay, so I think when you understand what you're trying to do, it's a lot easier to actually calculate. Yeah, I think I need to review this and just adjust this to how I recommend it, because I think when you do it that way, now you'll be fine. You'll be fine. Okay, and then here we have variable overhead expenditure and stuff like that. Right. Even here, I need to spin those around. At least here we have budgeted fixed, standard fixed, okay. So, okay. But yeah, usually they don't ask these ones, okay, but I still know them obviously. But those other ones they usually do ask. They like to ask these in the assignments and the tests. No, yeah,
So
no.
I see you only did a test 2.
Yeah, and then the exam.
The exam.
That's what I see they've
Those
done.
test twos on the top.
Test 2, I think it's learning units 1 to 4. Yeah, it's learning units 1 to 4. But guys, let me give you guys a break.
We're not gonna have enough time.
Huh?
We're not gonna have enough time.
Yeah. Okay. So you don't want to take a break. Okay, let me just at least break the video.
Unless,
Is it? Okay.
Yeah.